Good morning. Today we're diving into a fascinating options strategy that often sounds more complicated than it really is. Let's break down the long put butterfly, a strategy that's both clever and surprisingly approachable, even if you're new to options trading. It's designed for those moments when you expect a stock to stay put, not make any dramatic moves. At its core, the long put. Butterfly is a neutral strategy. You're not hoping for a big rally or a steep drop. Instead, you're betting that the stock will remain within a narrow price range. This approach is perfect for times when the market feels calm and predictable. Here's how you set it up. You buy one put option at a higher strike price, sell two put options at a middle strike price, and then buy one more put at a lower strike price. All of these options share the same expiration date, which is key to the strategy's structure. The reason it's called a butterfly is because, when you plot the potential profit and loss on a graph, the shape resembles butterfly wings. There's a sharp peak in the center and gentle slopes on either side. Your main objective? You want the stock price to settle exactly at the middle strike price when the options expire. That's the sweet spot where your profit is maximized. This strategy shines when you expect very little volatility. Imagine a stock that's just released its earnings or big news, and now it's likely to drift quietly for a while. In essence, you're placing a bet on calmness and stability, not on wild price swings or unpredictable news. If your prediction is right and the stock stays put, you stand to profit from the market's tranquility, often with a limited risk and a defined reward. The long put. Butterfly is all about precision and patience. It's a strategy for those who prefer a measured approach, rewarding careful timing rather than chasing after big, unpredictable moves. The long put butterfly thrives in calm, range-bound markets, where prices move within a relatively narrow band and there's little excitement or drama. This is the natural environment for this strategy, where it can perform at its best and offer the most consistent results. It's important to remember that the butterfly does not do well in wild, volatile conditions, where prices swing sharply up or down and unpredictability rules the day. Instead, look for stocks that have settled down after big events, such as earnings reports, major news releases, or sudden price surges. Once the dust has settled, these stocks often begin to trade sideways, moving within a defined range. These quiet periods, when the market seems to pause and catch its breath, are ideal for the butterfly strategy. Here, the lack of big moves works in your favor. Often, after a significant surge or drop, stocks enter a consolidation phase, drifting within a predictable range as traders wait for the next catalyst. This is when you want to pay close attention. That's when the butterfly can truly spread its wings, taking advantage of the lack of movement to generate potential profits from time decay and stable prices. Your job is to spot these lulls by carefully studying price charts, monitoring recent news, and identifying when a stock has entered a period of calm after the storm. This isn't a strategy for every stock all the time. You need to be selective, choosing only those stocks that fit the right conditions for a butterfly to work. It requires careful observation, patience, and precise timing. Rushing in or ignoring the market's mood can lead to disappointing results. You're seeking stability and predictability, not excitement or adrenaline. The butterfly is about discipline and waiting for the right moment. The best opportunities often come when everyone else is chasing the action and you're quietly waiting for calm. That's when the butterfly can truly shine. One of the biggest advantages of the long put butterfly is its built-in safety net. Your maximum loss is limited to the amount you pay to enter the trade. No surprises. The wings you buy protect you if the stock moves too far in either direction. Your potential profit is also capped, achieved only if the stock lands exactly at the middle strike at expiration. This strategy is about controlled risk and measured reward. It's ideal for traders who prefer precision and capital preservation over chasing big wins. You know your risk and your reward before you even start. Let's make this real with an example. The Walt Disney Company, DIS. Imagine it's June 9th, 2025, and Disney is trading at $100 after a quiet post-earnings period. You believe the stock will stay near $100 for the next month. This is the perfect setup for a long put butterfly. You'll target $100 as your middle strike for maximum profit. Choose an expiration about 45 days out, say July 18th, 2025. The planned profit if Disney stays stable, with limited risk if it doesn't. With your forecast and time frame set, you're ready to build the trade. Next, you'll pick 3 strike prices, $95, $100, and $105, all expiring on the same date. Let's break down exactly how you'd construct a butterfly spread using Disney options. This strategy is designed to profit if Disney's stock price lands near a specific target at expiration. Here's the setup. You start by buying one $105 put, then selling 2 $100 puts, and finally buying one $95 put. All of these options have the same expiration date, July 18th, 2025, so you're working with a single time frame, which keeps things simple and focused. Each leg of the trade is carefully chosen to create a defined risk and reward profile. The $105 and $95 puts are your wings, while the $100 puts form the body of the butterfly. All options expire on the same day, so you don't have to worry about mismatched timelines. Let's look at the prices. Suppose the $105 put costs $6. This is the higher strike put you're buying, and it's the most expensive part of the trade. Next, you sell 2 $100 puts, collecting $3.50 for each contract. Selling these puts brings in premium, which helps offset the cost of the puts you're buying. Finally, you buy the $95 put for $2. This lower strike put acts as protection, capping your risk if Disney's price drops sharply. To calculate your total outlay, add the cost of the puts you're buying, $6 for the $105 put plus $2 for the $95 put. That's $8 in total. Then, subtract the $7 you collect from selling the 2 $100 puts. This premium reduces your overall cost, making the trade more efficient. Your net cost to enter the butterfly is $1 per share, or $100 total for one spread. This is the maximum amount you can lose on the trade, no matter what happens. That $100 is your maximum risk, and it's fully defined from the start. You'll never lose more than this amount, which is one of the key benefits of the butterfly strategy. Now, let's talk about potential reward. The maximum profit is calculated by taking the $5 difference between the strikes, $105 and $100, or $100 and $95, then subtracting your $1 net cost. That leaves you with $4 per share, or $400 total for one spread. So you're risking $100 to potentially make $400. That's a 4-to-1 reward-to-risk ratio, which is quite attractive if you have a strong view on where Disney's price will land at expiration. This favorable ratio is why butterfly spreads are popular among traders who want to target a specific price range without exposing themselves to unlimited risk. It's a strategy that rewards precision and planning. The butterfly isn't about chasing huge moves or wild swings. Instead, it's about setting up a trade with a clear plan and a well-defined outcome. It's a conservative approach, perfect for traders who want to manage risk while still aiming for a solid return if their forecast is correct. Now let's walk through the steps to actually place this butterfly trade in your brokerage account so you can see how it all comes together in practice. Placing a butterfly trade is easy with modern brokers. Use the platform's butterfly or combo order tool to enter all 3 legs at once. Input the stock, DIS, expiration date, July 18th, 2025, and strikes, $105, $100, $95. Set your limit price at $1 per share, $100 total. The order will only fill if the market matches your price. Once filled, your position appears as a single butterfly spread. The $100 net debit is your maximum risk. Always use the combo order. Never try to leg in one piece at a time. This ensures you get the price and risk profile you want. Now, you're officially in the trade. After entering the trade, your main job is to wait and monitor. Time decay works in your favor if the stock stays near $100. Watch the position, but don't overreact to small price moves. You don't have to hold until expiration. Set a profit target, like 50% of max profit, $200. If the stock moves away from $100, losses increase toward your $100 max risk. Consider closing early if losses reach a set threshold, like $50. Having clear exit plans for both profit and loss is key. Discipline and patience are your best tools. Let the strategy work, but be ready to act if the market changes. Fast forward, a week before expiration, Disney is at $100.50. Your butterfly is now worth $3 per share, $300 total. You sell to close, locking in a $200 profit. Use the same combo order to close all 3 legs at once. Enter a limit price for your desired credit. Once filled, your profit is realized and the trade is done. Always close before expiration to avoid assignment risks. If the trade goes against you, say Disney jumps to $108, your spread might drop to 20 cents per share. Closing early limits your loss to $80 instead of the full $100. Controlled losses are part of the strategy. The key is sticking to your plan, win or lose. Let's recap the pros and cons. Pros: high reward to risk ratio, strictly limited risk, low cost and profits from low volatility. It's a great way to diversify if you usually trade on big moves. Cons: the profit zone is narrow. You need the stock to land near your middle strike. The chance of hitting max profit is low, and commissions can add up. Managing the trade takes some experience. It's not for absolute beginners, but it's a disciplined, elegant approach for those who value precision. Weigh these factors before adding the long put butterfly to your toolkit. Used wisely, it's a powerful strategy for calm markets. The butterfly rewards patience, planning, and a steady hand. Thanks for watching and see you next time.